And let's step a little away from the US-India trade deal. Hear it out from Yashish Dahiya, the chairman and group CEO at PB Fintech, in an exclusive chat with Harsh on the back of their strong show in Q3 and the possible fundraise as well.
So I think if you look at the last 12 quarters, we had been growing at about 40% on average. And if you looked at just the health insurance part, we were growing at about 60%. What's happened in the last quarter is our health growth went from 60 to 80. And thus that increased growth, so if you can think about it, from 1.6 to 1.8, clearly came on account of GST, where because the government made such a big announcement, for the consumers, it became a talking point and became a reason to buy health insurance now. So clearly it has helped. And while the initial demand surge we saw from GST is no longer there, but the conversion rates have gone up much higher now. Because many people have bought, the conversion rates are much higher. And so this growth rate is continuing, at least for now. Now, of course, growth of this sort is untenable for a very long period. And at some point, it may not be there. But it clearly has had a benefit. And it doesn't seem to be slowing down just in one quarter. It seems to be carrying on from an overall sales perspective.
Tell me, Yashish, what's changed for you as a company structurally? Because what we've seen is we've seen a hockey stick kind of growth where it comes to your EBITDA. Talk to us about what levers you're using to achieve that, because now you're well on course towards profitability. You've guided for FY 27,000 crore PAT. And I believe that you'll likely exceed that just based on the numbers you're clocking. But just talk to us about the levers you're using so that we get a sense of the direction and the sustainability of that.
If you are an internet platform, what is any internet platform? They have certain fixed costs. You undertake a lot of brand costs, marketing costs, technology costs to build up your platform. But at the same time, on an operating basis, you also have high gross margins and high contribution margins. And thus, once you break even, your profit growth is not linearly linked to your revenue growth. It increases very rapidly. And, let us say our contribution margin is, let's say 30% or so, or 40%. Then over time, your fixed cost starts to become smaller and smaller and smaller as your scale grows, because it's largely fixed. And if you notice, our brand costs, our technology costs, all of those start to become fixed. They're a very large cost. It took us 14 years to break even. But once you break even, the profit comes very rapid. In fact, I would say that's the only way to judge whether a company is actually a platform-based company or not. Because as you grow, your operating costs don't grow as fast. And I think that is the benefit you receive. Now, of course, in terms of payouts, the two kind of primary products we sell, life insurance and health insurance, are different. In health insurance, you get paid very little upfront. In fact, in the first year, we almost make a loss. Last quarter, we were profitable in the first year sales, but otherwise, usually we make a loss in the first year. And we recoup that through our renewals. So the profits in the health insurance really come from renewals. On the other hand, in life insurance, because it's much more upfront payment, most of the profits come from fresh sales. So usually you will see if our growth is very high, sometimes our profit can be depressed for a while. And that is because of the health insurance business. While in the life insurance business, if growth is high, your profits come very, very rapidly and they follow very quickly. So, but overall, the profits keep growing because of these scale economics.
And with regard to agency, you've gone into agency as well now. So in the sense that physical agents helping your customers buy insurance, that should likely pressure costs, or are we at the peak in terms of now the growth rate will largely be in line with the kind of growth that you're seeing on your top line as well in terms of physical sales of insurance?
So I just wanted to clarify one very simple thing out there, Harsh. There are two kinds of agents. One whom you will pay a certain amount to get you business. And that does not change, because if you are paying somebody, let's say 20%, 30% to get you business, you will have to pay them 20, 30% in the future also, right? Or 20, 15% or whatever that be. And that is the POSP business. The POSP business, or the point of sales presence business, or the agent network, that is that. So in that, whatever commission we receive, most of it has to be passed on to the agent. It's a pass-through, flow-through business. These tend to be high volume, low margin. So as you scale up, your profits don't change much, but also you never made large losses to start with. Then the second is the core business, the one that is coming through the internet. And here the hardest thing is bringing the customer in. So your marketing, branding costs are the biggest costs. Actually, your cost of service is not your biggest cost. Seems like a lot, but actually is not your biggest cost. It's because you have a customer who's already ready to buy. And now servicing that customer in whichever form, whether it's online, whether it's physically meeting, is your prerogative, and you must do that in order to get the conversions. Your actual cost of servicing is not very different. Whether you do it through physical, because you're paying the employee the same salary. In one case, you will have network costs, as in telecom costs, etc., office costs. In another case, you may have travel costs. But your costs are the same. As long as the person is being just as effective through physical meetings, it doesn't really matter whether you... So the difference is it an employee or is it somebody whom you are paying a variable commission to? On the variable commission side, it will, your margins are lower. But on the employee side, the productivity benefits are what you keep.
Understood. And you would say that predominantly you're more on the employee model than on the agency model.
Our core business is only on the employee model.
Understood. Understood. Got it. Yashish, you've got roughly 5,000 crore of cash, the last I checked. Correct me if I'm wrong. And now you're generating cash as well. This QIP really required? What is it? What's the likely intent? Where do you go?
I think should we get board approval and should we get shareholder approval and we finally do the QIP, the objective is international M&A, and the classification is very clear. We're looking for large established markets with large pools of profit and stable markets where we believe, because of our unique skill set, we have a transformation capability. However, even if the transformation capability were to not work for whatever reason, the profit pool and the stability of the business is still there. The second thing we are looking at is familiarity with the territory and the confidence in the transformation. I think we have a high degree of conviction that with whatever we have learned at Policybazaar in the last 17 years, we can bring a lot of learning, specifically in complex products like health insurance or life insurance, to the to the table, and we will do that. The last thing is India being a MNC hub for digital businesses. I think its time has come. Eventually we have to. Why should only Google and Facebook from American companies work in other markets? Why can't Indian companies operate in consumer markets of other countries? And a lot of that IP which is going to be developed, why can't that reside in India? That is also one thing that drives our thesis.
But you've already got, sorry for pursuing this, but you've already got 5,000 crore of cash. So largely you're trying to look at an acquisition which is larger than the cash pool that you have, or is there a deployment strategy for the cash pool you have already and the incremental QIP proceeds will go towards international? I'm trying to get a sense of that.
We don't have an identified target yet.
Got it.
But yes, we do believe we will require that money. We may also require further debt in addition to that money. So yes, I think if we were to move ahead in those geographies that we intend to, then the money would be required. That's precisely why we are raising it.
And MGA, how does that deliver better returns for the Indian insurance ecosystem? What's your take on that?
I think the MGA is perhaps the most transformative step that can happen in the insurance industry. It's exactly like NBFC was to banking. Think about it. If NBFCs had not happened, who would be giving loans on televisions? Who would be giving loans on, white goods, there's just so much innovation that NBFCs were able to do. Why were they able to do that innovation? They were able to go into the non-salaried segments. They were able to go into the hinterlands. Otherwise, our banking system would have been restricted to the salaried few, right? Because the banking system was able to take care of that. It is exactly the same in insurance. Because of the structure of the insurance industry, we are restricted to servicing maybe 15% of the population.